Hello guys. So for today's class, hang on, there's some chat message. Yeah, okay. So for today's class, we're going to move on to the next topic, which is international financial markets. And in particular, we focus on the debt market. So for this particular topic, we'll be talking about the international debt market, okay, including the banking sector and some of the other financial products in the debt markets. Now, before we start, I have uploaded some documents for the final exam in LMS on LMS. So there are two documents. The first one is a PowerPoint slides where I've got some detailed information about your final exam. And second, there is an instruction about how to answer calculation questions on your computer, right? So on the online system. So if you have read these documents already, and if you have any questions, feel free to ask me now before we start the lecture, or we can talk about it during the break in between, okay? Whatever you prefer. But yeah, I would recommend people read these documents, and if you have any questions, make sure you ask me before the final exam, okay? All right. So the readings for this chapter would be, for this topic would be chapter 11 on the international banking sector. So for the lecture today, we will have two parts. In the first part, we'll talk about the international debt markets with our focus on international banking sector. And then we're going to take a break. And after we come back, we will discuss two sort of big debt crises in the past, right, on a global scale. So this topic is one of my favorite topics, and I personally research in the debt market. The reason why I think debt financing is interesting is because it is relevant for not just companies, but also for individuals, right? So if you think about individual like you and me, if you go and buy a house tomorrow, you probably would be going to a bank to ask for a loan, okay? Whereas if you think about another type of financing, which is equity, issuing shares into the market, it's pretty much just for the corporate sector, right? So with debt financing, pretty much every adult will likely have one form of debt or another. So as a result, I think debt financing is quite relevant for the everyday life of everyone, okay? So the goal of this particular lecture is to discuss the different ways companies can raise funds from the debt markets, from the international debt markets, and also the issues that we need to worry about when we talk about debt financing, right? So between equity and debt financing, by construction, you can only default if you have a debt in place, right? So you can only default if you borrow from the bank, for example, and you fail to pay your interest payment or pay back the principal, okay? So with debt financing, even though it's a bit more flexible and it's easier to access for most of the companies, it comes with a danger of bringing your company to default, okay? So, and as we see from the past, every time when there is a debt crisis, it's normally very messy and it's harder to fix, okay? All right. So let's talk about the first part of the lecture. So in the lecture today, I want to talk about the international banking services. I want to introduce why international banking sometimes is good for a company, and also what are the different products in the debt markets. And finally, I want to talk about hedging interest rate risk, okay, using forward rate agreements. So the reason why international banks exist is to facilitate trades across the border, right? So international banks do everything like a domestic bank, and on top of that, they help arrange transactions across the border. So for example, it includes arranging trade financing. So every time when you trade with a trade partner, normally the two trade partners will have two banks in between so that they can arrange trade credits, okay? You could also convert currencies using an international bank. You could also ask them for hedging services like forward contracts, so on and so forth, right? So in terms of the scale, this slide shows you the 10 biggest international banks in the world as of 2016. And as you can see, the big economies tend to dominate in this, okay? So for comparison, today's market cap of Commonwealth is around 109 billion Australian dollars. So that is around 69 billion USD, okay? So these numbers are in the USD as of 2016, okay? So our Australian banks, even though we have a small banking sector in Australia, but our big four are quite large, right, on an international level. Okay. So what are the reasons for companies to, what are the reasons for banks to involve in the international market, right? So firstly, assuming that you have already spent money to develop expertise in the banking sector, then it makes sense for you to reach out to the international markets because it will give you the cost of reaching out to the international market is quite low, given that you have already invested in your banking business, right? In addition, the international banks provide additional knowledge advantage. So the subsidiary in the foreign country of the bank can draw on the parent bank's knowledge of personal contacts and credit investigations for use in that foreign market, right? In addition, for local firms that use international banks, they have an advantage relative to just a domestic bank because the international banks have knowledge in the other countries as well. So if you want to go overseas, you can use the services that the bank has in that other country as well, right? In addition to that, some international banks have a reputation capital that help them attract more customers, right? Because of prestige. So if you're around for a long time, you accumulate enough reputation capital that might help to attract new customers. Sometimes going overseas are also good for the banks to avoid some of the strict regulations in their home country, okay? So for example, if you establish a subsidiary in Australia, they might be subject to different regulations relative to the domestic banks. So the subsidiary might get a lower regulatory cost, okay? In addition, for the banks, if they have a big multinational company as a customer, and if they want to keep their business, then it makes sense for them to follow the customers abroad to avoid losing them to another business, right? In addition, having business overseas also help you serve your retail customers better, okay? So for example, Commonwealth, they used to have an ANZ as well. They used to have an Asian banking arm. So if you have a card with ANZ or Commonwealth, you used to be able to withdraw your money in Vietnam, for example. So it gives you a bit more flexibility for the retail customers. Transaction costs. So I mentioned this point before. So with some of the countries where there is strict capital flow restrictions, so for their national banks, it makes sense for them to go overseas to trade, to provide business so that they can avoid these currency controls, right? Another reason is growth. So when you reach out overseas, of course, you are exposed to a bigger market, so there will be more opportunities for growth, okay? Another advantage is risk reduction. So if you reach out to a bigger market, you can diversify your portfolio, and so it will give you some more risk reduction benefit, right? So diversification sometimes comes up as a big issue, as one of the contributing factors for why banks fail, okay? So in the debt crisis that we talk about later on, we will see why some of the banks fail after the South American debt crisis, okay? That was because they invested too much in the Latin American countries, okay? That were in trouble at that time. Right. So in terms of regulating international banks, the countries around the world agree on a standard called the Basel Standard, and this was established by the Basel Committee in 1988. So the Basel Committee is in charge of setting a certain set of regulations, banking regulations or recommendations, so countries around the world can follow to regulate the banking sector, right? So one of the biggest concerns for banking regulators around the world is capital adequacy, which refers to the amount of capital that banks have to hold to make sure that they are financially healthy. Okay. So if we think about a banking business, their business model is that they borrow money from depositors. So every time when you open a savings account with a bank, you're effectively lending to them, right? So on the liability side, they've got a big loan book. I mean, they've got a big liability book from depositors. And on their asset side, as they lend out to their customers, they hold loans in their portfolio, right? So for banks, therefore, one of the biggest concerns for regulators is that they might be borrowing too much, right? So they might be taking on too much debt on their book. And as a result, to regulate these banks, they are required to hold a certain minimum amount of capital called capital adequacy. Okay. So according to the Basel Committee, the best way to regulate banks is to set up 3 different pillars of capital adequacy, under which the banks are required to do certain things to make sure that they have enough capital reserves to buffer any crisis. Okay, so the first pillar is at the capital the capital reserve of the bank. So this is internal regulation. So banks around the world are required to maintain a minimum level of capital depending on their risk-adjusted asset size. Okay, so if the bank takes on a lot of risky loans, they will have to hold more capital in their book, and vice versa. Okay, so I think at the moment the regulation is you have to hold at least 8% of your asset in capital, in equity finance as capital for the minimum capital requirement. Okay. The second pillar is supervisory review process. So with the second pillar, this is external monitoring. So the regulators will impose certain review or monitoring process on the banks to make sure that they follow the guidelines from the regulators. Okay. The third pillar of monitoring is market discipline. So this is when we talk about the role of the share market as another tool to discipline the bank. Okay. So how does market discipline work? So market discipline works through the shareholders selling and buying of the shares. So for example, if I am a shareholder of Commonwealth, and if I think that the bank is taking on too much risky loans, okay, and I'm not happy about it, I think it's being too risky. So what I can do as a shareholder is I can sell off my shares in Commonwealth. And if I'm a big institution with a lot of market power, as I sell the shares in the market, it will create a downward pressure on the share price, making the market capitalization of the bank suffer, right? So to prevent big powerful shareholders to do that, banks have to maintain a certain healthy level of capital requirements so that the shareholders, to avoid triggering sell off from the shareholders, right, from the big shareholders. So this is what we call market discipline. Okay, so the banks are disciplined by the market participants. So over time, as we progress through numerous debt crises in the past, the regulations have become stronger and stronger over time. Yeah. So, for example, in 1998, when the Basel regulations first came about, people only care about credit risk, right? So you just look at the credit risk of your book and you calculate your capital based on it. Over time, progressively, they realize that banks' loans are not always equal in terms of the risk. So there are some assets that are more risky and some assets that are less risky. So as a result, they introduce a concept called risk-adjusted capital, where the riskier banks are penalized more with higher capital requirements. Okay. So after the crisis in 2008, in the global market, people realize that liquidity is another important figure, another important consideration that we need to think about. And so banks are now required to hold a certain liquidity reserve as well. Okay. So the regulations evolve with the banking, with the development in the banking sector as well. Okay. So in the next few slides, we'll talk about the different types of financial instruments that are traded in the international money market. So when we say money markets, we are talking about large wholesale instruments that are typically traded between the big financial institutions and other corporations. Yeah. So here in the international market, you can trade a financial instruments denominated in your domestic currency in other countries, right? So for example, if I am PHB, right, I'm an Australian company, and I want to raise a debt instrument in the US, right? I could write a debt instrument denominated in Australian dollars that is traded in the US market, okay? So for these kind of debt instruments, they are, we say that they are denominated in the euro currency. So when we say the euro currency, we are talking about a currency that is traded in a country different than the local country, right? Different than the home country, okay? So for example, euro dollars are the US dollars denominated instruments traded in countries other than the USA, okay? Similarly, euro yen are the yen denominated instruments traded outside of Japan. Okay. So the bottom line is that these currencies are traded outside of their home country. Okay. And the banks do not have to be located in the euro. So the euro currency market is a money market. So it's a wholesale interbank market where the transaction size is quite large. So every transaction is $1 million or more. Okay. Now, when you trade currencies in the money markets, normally the interest rate on your instrument is quoted as a spread above a certain base rate. Okay. So your interest rate is normally a spread, say 10%. I'm making it too much. Let's say 10 basis points plus a base. Okay. So the base rate is a reference rate that most banks will use, and the common base rates are the LIBOR rate, so the London Interbank Offer Rate, PIBOR rate, so Paris Interbank Offer Rate, so on and so forth. Now, the reason why banks quote the interest rate like this is because the base rate represents like the minimum cost that the banks have to have to spend to be able to give you the loan. Okay, so for example, if the banks borrow from their central bank at the base rate, then they would charge their customers a premium above that base rate. Okay, so the base rate is their financing cost. So this reflects the financing cost of the banks. On top of that, they would charge you a risk premium. So this spread here will depend on each customer, each industry, and each country, right? So if you are a riskier customer, you will be charged a higher risk premium, and vice versa. Okay. So the interest rate in the bank loan therefore reflects two things. The first is the funding cost that the bank faces, and second, the riskiness of their borrower. Okay. So we have another instrument called the Euro credits. So these are short to medium term loans of Euro currency. So these are loans denominated in the Euro currency. Okay. So normally with Euro credits, because they are large, so this is the wholesale market, normally they will be written by a bank syndicate. Okay. So a bank syndicate includes many multiple banks, and each of them chip in a part of the loan. Okay. So in a syndicated loan, in the lending syndicate, sorry, so the banks that together lend to the same customer on the same loan is called a lending syndicate. So the structure of the syndicate is normally as follows. You're going to have a lead bank or an arranger. And then you're going to have participant banks, okay? So the lead bank is the most important member of the lending syndicate, because they are the one that is in charge of screening the borrowers, monitoring the borrowers, and communicating between the lending syndicate and the borrowers, okay? So the lead bank is in charge of servicing the loan, if you like, and the participant banks will rely on the lead bank to monitor the borrower, okay? So as a result, for this service, the lead bank tends to charge a fee, right? Euro credits normally feature an adjustable rate, so this is a floating sort of loan, okay? So Euro credits originating in London use the base rate, use the LIBOR as the base rate. So typically with syndicated loans, the most common base rate is the LIBOR, not just Euro credits originating in London, okay? So I do research in US syndicated loans, and most of the time the base rate is also the LIBOR, okay? Finally, we will talk about Euro notes. So with notes, if you have a debt note, they tend to be a short-term sort of debt instrument, right? So Euro notes are short-term notes underwritten by a group of international investment banks or commercial banks, okay? So they have the same structure as a zero coupon bond, in the sense that they are sold at a discount from the face value, and at the maturity, investors will get back the face value, okay? So you buy the note at the lower price than the face value, and at maturity, you receive the face value, and the difference between the price that you buy and the face value is the interest on the loan, okay? So this is a short-term instrument, and the maturity is normally 3 to 6 months, okay? All right. So we have introduced a few different types of money market instruments traded in the Euro currency market. In the next slide, we'll talk about how companies or banks hedge their interest rate risk, right, using forward rate agreements. So forward rate agreements please just forward contracts written on interest rate. Okay, so we have talked about forward contracts before. These are contracts that allow you to fix a rate or a price for a future delivery. Okay, so the rate that we talk about here in forward rate agreements are interest rates. Okay, so the definition of a forward rate agreement is that it is an interbank contract that involves two parties, a buyer and a seller. So the buyer is the person that agrees to pay the seller the increase in interest cost on a notional amount if interest rates fall below an agreed rate, right? So here I've got two members. I've got a buyer and I've got a seller, okay? So their agreement is as follows. So whenever the actual interest rate, I'm going to say AR for actual interest rates. Sorry, AR is agreed rate, okay? And actual interest rate is, let's say, this R, okay? So whenever the actual interest rate in the market falls below an agreed rate, so in this case, let me write it in a different way so it's easier to understand. So if the actual interest rate at the time that I settle the contract is lower than the agreed rate, then my buyer will be paying to my seller, okay? Alternatively, when the actual interest rate is greater than my agreed rate, then the seller is going to pay to the buyer, okay? And how much do they transact between each other? They are going to pay the difference between the interest in the market and the interest agreed on the contract, okay? So this is called a net settlement. You only just settle the difference, okay? So just like any forward contracts, you can also use the forward agreements for speculations as well, okay? I'm going to show you how on the next slide. So to graphically demonstrate the payoffs for a long and a short forward position, so a long, I'm going to call this FRA for forward rate agreement. So a long FRA position will look like this. It's an upward sloping line. Here I've got the interest rate in the market, okay? So this is actual interest rate. And here I've got my agreed rate. So this is the rate that is written in the contract, okay? So this is a short FRA position and the payoff function is a downward sloping line, okay? So what it says here is that every time when the interest rate, when the actual interest rate is lower than the agreed rate on the contract, the buyer, so this line belongs to the buyer, yeah? The buyer agrees to pay to the seller, okay? This is how much they are going to pay, okay? And because the buyer pays the seller, this is going to be a loss to the buyer, okay? Does that make sense? So the buyer experiences a cash outflow, okay? When SR is lower than AR. Alternatively, when the interest rate is greater than the agreed rate on the contract, in this case, you can see the buyer makes a gain, right? This is because under this situation, the buyer received money from the seller, okay? So in this case, this is a gain for a buyer of a FRA, okay? In contrast, for a short position, I will make a gain when the interest rate in the market is lower than the agreed rate because the buyer pays the seller. And I'm going to make a loss if the interest rate in the market is greater than the agreed rate. Okay. So if this is the case, if I think that the future the future interest rate is going to increase, and if I want to speculate, do you think I want to be buying a FRA or do you think I want to be selling a FRA? If I think the future interest rate is going to be increasing, right? It's going to be higher than the agreed rate. So in this case, do I want to long or do I want to short? I'm going to start a poll. So here I'm looking at a situation where my expected future interest rate is going to be higher than the agreed rate. Okay. So if that's the case, do I want to long or do I want to short the FRA contract? So I've got one answer here for long. What about the other people? So here, if I want to speculate based on my forecasts like this, which contract will give me a profit? So here I'm going to agree with the people that say a long FRA position, okay? So if I think that the future interest rate is going to be higher than the agreed rate, I want to be here, okay? I want to be along this line here. And so I want to be taking a long position in the FRA, okay? All right. Well done, guys. Now, one more question. Suppose I borrow, say if I have a future borrowing, right? So in the future, I'm going to be a borrower. So in 3 months' time, I need to borrow. So for me, I'm worried about interest rate movements, right? So in this case, if I want to hedge my interest rate risk, do I want to be having a long position in the FRA or do I want to have a short position in the FRA? So now I want to hedge a borrower and I want to, right, so in the future, I'm going to borrow money. And in that case, do I want to be long or do I want to be short to hedge my interest rate risk? I've got one answer here. So to answer this question, number one, you need to identify what is your exposure, okay? So are you afraid that interest rate is going to go up or go down, okay? Number two, you need to choose a position that will help you offset the loss if the interest rate move against you, okay? So I borrow. So I've got 6 answers. What about the other people? Okay. Well done, guys. Now I've got 5 people choosing answer A, and this is the correct answer, right? So well done to you guys. Now, so to think about which position to choose, I need to know what exposure I'm worried about, okay? So as a borrower, I'm worried about interest rate going to go up, okay? So I will lose money when interest rate is going to go up, okay? So as a result, I want to enter into a position that will make a gain when interest rate goes up so that I can use that gain to offset my loss in my borrowing, okay? So here, the position I'm looking at is this one here. So as interest rate goes up, I'm going to make a gain in my FRA, and that will give me a protection for my underlying asset, okay? So therefore, I long a FRA, okay? So this is how people, borrowers and lenders use this contract to hedge their interest rate risk, okay? So if you are a borrower, you want to be long in a FRA contract, and if you are a lender, you want to be short in a FRA contract, okay? Okay, let's move on. That's good. All right, so let's look at one example of how a FRA or forward rate agreement works. Now, suppose I have a 3 against 9 FRA. Right, so here I've got the 3 versus 9. Oopsie. So if this is a 3 versus 9 FRA, what it tells me is that the contract is going to be settled in 3 months' time. And the loan horizon that I'm looking at is a 6-month loan horizon from month 3 to month 6, to month 9, okay? So this is a 3-month forward contract on a 6-month interest rate, okay? For a 6-month period, beginning 3 months from now. So 3 versus 9 means 3 is the start. So this is when I calculate my loan interest. And 9 is the end. This is when the loan matures, okay? So here, this is where I am at the moment. And this is the contract I'm looking at. So if I enter into this contract, that means I agree to settle the contract in 3 months' time by cash settlement. And I need to say cash net settlement, okay? The contract will be written on a 6-month horizon for a 6-month interest, okay? So you want to look for an interest rate for this particular period, okay? So to calculate the amount of the settlement between the buyer and the seller, I'm going to follow this, this formula over here, okay? So this is my settlement amount. Now it will be given by the notional amount times the interest difference between the actual interest rate and the agreed rate, adjusting for the time, the maturity of the loan, okay? So the days here are the number of days between month 9 and between month 3 and month 9, okay? So for our particular example, it will be 6 months. That means it's 180 days, okay? So besides this term, I'm going to have a present value term here as well. So 1 plus SR times days divided by 360 is a present value term, okay? So why do we need a present value term here? That's because the interest difference that we computed are the interest that we expect to receive at the end of month 9, okay? So the interest amount that we calculated before, which is the notional amount, times SR minus AR, times days divided by 360. All right. So this is a cash flow for t equals to 9. But because we settle the contract as of this time, we are going to need to calculate the present value for that cash flow. Okay. So that explains the present value term in your formula. So to give you a numerical example, let's consider a FRA contract written on a notional amount of 5 million euros. So the agreed rate here is 4%. This is a 3 against 9 FRA contract. We enter into the contract in January 2018. That means the contract will be settled in March, and the loan is going to be calculated for the period between March and September. Okay. So to be exact, there are 184 days between these two time points. So for a 3 against 9 FRA, my payment, my settlement is going to happen in 3 months' time. And the settlement will be the difference between the two. Okay. So the settlement amount would be calculated based on this formula here, which is what we saw on the previous slide. So on this day, we need to determine how much we need to settle and who pays who. Okay. So how much we are going to settle depends on this formula, and who pays who depends on the difference between the actual interest rate and your agreed rate. Okay. So on the settlement date, if the actual interest rate is the same as the agreed rate, there is no payment, okay, because SR minus AR is 0. On the settlement day, if the actual rate is greater than the agreed rate, then your buyer gets the payment and your seller has to pay, okay. Alternatively, if that's the opposite, if SR is lower than AR, then your buyer has to pay, okay. So it is quite similar to a forward payoff function for currency, okay. The only difference is the formula is different, okay. All right. So that is the first part of the lecture today. So we have talked about the detailed information on international debt markets, and we have discussed how to hedge interest rate risk using FRA. Okay. Now let's take a short break for 5 minutes, and when we come back, we will talk about debt crisis. Okay, which is the second part of the lecture. So let's come back at 55. Okay, let's move on to the second part of the lecture. Any questions for the exam? If you have got a chance to look at the notes. Okay. If not, I'm going to talk about international debt crisis. Okay. Good. So with the international debt crisis topic, the goal is to illustrate to you how when a company or a group of countries get into a situation where they overborrow, then it could be it could trigger a very, very messy crisis. Okay. So through the two examples of international debt crisis we talk about in class, I hope to be able to illustrate how the problems in each of the crises and what could be a possible lesson that we learn from each of the crises. Okay. So the notable crises in the past are firstly the debt crisis in 1982. So this was mostly the problem for Latin American countries like Mexico, Brazil, so on and so forth. Okay. And the second crisis that we talk about is, of course, the financial crisis in 2007, 2009. Okay. So the key difference between the two crises here is in the complexity of the financial instruments that are used in the two crises. So back in 1982, there were not much financial innovations around, right? So technology was not that great before. So credit risk modeling was less complex. And so the problem was pretty much an economic problem, okay? With the financial crisis in 2007, the story is a little bit different, okay? So it was caused partly by the complexity of the financial instruments used in the subprime mortgage market, okay? So let's go through each of them. So let's talk about the international debt crisis 2082 first. Now, the crisis was marked on August 20 in 1982. This was when Mexico asked for debt forgiveness from US and foreign banks, right? So the Mexican government realized that they could not pay the debt anymore, and they were negotiating for forgiveness of $68 billion, right, at that time, okay? So that was 30 years ago, okay? So 68 billion is much, much more valuable back in 1982, okay? So the problem started in the early 1970s. That was when the oil countries, the OPEC countries, started to hold a lot of savings, right, in the USD. That was the proceeds from selling oil. So what they did was they were looking for banks to invest this money in, right? So they were looking for investment banks, commercial banks, so on and so forth, to invest this liquidity windfall. So as a result of this investment from OPEC countries, banks around the world started to have a lot of money to invest. Yeah. So by 1976, these countries, the OPEC countries, have deposited around $100 billion in the banks around the world. Okay. So from a bank's point of view, when you have customers depositing money into your bank, of course, you have to pay them interest, right? So what you need to do is therefore to take that money to invest somewhere else, hoping to earn higher interest so that you can earn the spread in between, okay? So as a result, for these banks with a lot of liquidity in place, they are going to need to find ways to invest, okay? And typically, if you invest in riskier countries, you will get higher returns, okay? So third world countries or less developed countries, if you like, were an option because there were more opportunities and they could charge a higher risk premium for these countries, okay? So it got to a point where this process was called the petrodollar recycling, in the sense that these banks, the Euro banks, they invested in the third world countries, the Latin American countries, and who in turn use this money to further buy oil. Okay, so the money started from the OPEC countries who sold oil to get that money, and then they gave it to the banks, the Euro banks. These banks then lent to the third world country, who in turn use the money to buy oil from the OPEC countries again. Okay, so as the OPEC countries started to have more money payment, the cycle began again. Okay, so the investment were okay, but up until a point where the oil producers decided to raise their oil price. Okay, so in the late 1970s, the OPEC countries started to raise their oil price, and at the same time, we see a recession in big countries around the world, right? In industrialized countries, and because of the recession, these countries started to demand less in their commodities. Okay, so if you think about the less developed countries, a lot of them earn income from selling commodities. Okay, like natural resources, wheat, so on and so forth. So as the richer countries demanded less of these commodities, the lower income countries, they have lower, the less developed countries started to have lower income, right? At the same time, there was some economic troubles in the the less developed countries. So in these countries, political uncertainties started to lead to higher real interest rates, and that increases the borrowing costs of these countries. Now, the problem becomes severe because these countries realize that they have been borrowing USD denominated debt, okay, on a floating basis, okay, meaning that the interest rate is variable and it increases as the risk of the borrower increases, okay. So there were two problems. The first one was that the interest rate is floating, is variable, and it increases as the troubles in the less developed country increase. And second, these loans are USD denominated, right? So if a third world country economy started to decline, their currency value started to depreciate against the USD as well. So the end result is that the notional amount of their loan in the USD is going to increase, and at the same time, the interest rate on these loans started to increase as well, given the riskier um, economy. Okay, so the combined effect of a lower revenue from selling commodities and the higher cost of borrowing is that these companies started to find that they are unable to meet their debt obligations. Okay, so the borrowing cost becomes too expensive for these countries, and eventually they had to default on their debt. Okay, so to give you an idea of how big the crisis was, so at the peak of the crisis, the Latin American countries and other developing countries owe in total $1.2 trillion. Okay, so on the picture on the left, here I've got a person and $1 million in cash. Okay, so if you have $1 million and you withdraw them in $100 notes, it will be this much. Okay, if you have $100 million, it will be half the size of a human. If you have $1 billion, it will be this much. Yeah, but if you have $1 trillion in debt, then this is you, this is a human, and this is how much debt you are looking at. Okay, so the problem was very huge because we're talking about country level debt. Okay, and also as we mentioned before, as the currencies of the Latin American countries depreciated, the dollar value of their loan becomes even larger. Okay, so as a result, in the end, they owe a lot of money. Okay, so in terms of their income, in terms of their GDP, for example, in 1989, we estimated that the World Bank estimated that the developing countries had debt outstanding equivalent to about half of their GDP. Okay, so that's about half of their income going to pay borrowing costs. Interest payments alone accounted for about 22% of their export income. Okay, so whatever you sell, you need to put aside about 22% just to pay for your debt. Okay. So what was the impact of this crisis on international banks? So on this slide, I've got the different banks, the most affected banks following the crisis in 1982. And I'm just looking at Mexico as a single country, right? So we're not looking at the entire debt portfolio. We're just looking at Mexico individually. So these are the loans that these banks made to Mexico. So Citicorp was the biggest loser because they made about, I think this is in billion dollars, okay? So they have about $2.9 billion lent to Mexico, followed by the other banks, okay? So if you notice, most of these are American banks. So that was because the Latin American countries were closest to America, so they tend to borrow from the US banks, okay? Now, if we compare the size of their loans to Mexico to the reserve that they put away to buffer against their developing country portfolio, we will see that the loans to Mexico alone basically eat up all of their reserve, okay? So for example, with Citicorp, their reserve is only 3.4, but they lend to Mexico 2.9, okay? Similar for these banks as well. As you can see, the losses that they made on Mexico alone eats up all of their reserves, okay? So that is how severe this crisis is for the banks involved. Okay, so the main lesson here is that these banks did not diversify their portfolio too much. They were investing too much in Latin American countries, okay? So what was the reason for that? Why did the banks invested all of their money, not all of their money, but a lot of their money in one single segment of the market, which is Latin American countries? So one reason was that because of the large liquidity that they got from the OPEC countries, they had to quickly find a place that yield them high interest rates, right? And Latin American countries at that time needed a lot of money for their development. They did not very carefully analyze the riskiness of their borrowers. Also, some of the banks claim that the US government were encouraging them to lend to the Latin American countries as well, right? But the bottom line here is there was lack of diversification, too much investment in one segment of the market, okay? Unfortunately, that segment did not do well and they suffer a lot of losses, okay? So in terms of the resolution, so after the crisis came about, there were two major solutions for the crisis. The first one was to construct a debt for equity swap, okay? So debt for equity swap is a situation where the creditor banks and the debtor countries involve a multinational corporation in between who provides, how do I say, who stands in between to buy the bad loans from the creditor banks. And then in exchange, they invested in the debtor banks, okay? I'll show you a graph later on to illustrate. So basically, this is how a debt to equity swap looks like. Now you've got your international bank. This is your creditors, right? So this is like, say, Citicorp. Now Citicorp, suppose Citicorp lends $100 million to Mexico, and now it has become a bad loan, okay? So what Citicorp can do is that they can sell the $100 million loan from Mexico to another corporation. So it can sell to like PHP, for example, at 60% of the face value, okay? So for Citicorp, they have to discount their Mexican loan by 40%, okay? But in exchange, they recoup 60% of their investment in the USD, okay? So for them, the benefit is that they get to recoup $60 million for their $100 million loan. Okay. Now, the multinational corporation would in turn redeem this debt with the central bank, with the debtor bank. So this is your borrower. So this multinational company agrees to redeem the debt at 80% of the face value in the local currency, right? So in the case of Mexico, for example, it's going to redeem the debt at 80% of the face value, but in the Mexican peso, right? So this gives the debtor countries a protection against further depreciation of their currency, right? So for this company, the benefit of standing in between to provide a debt for equity swap is firstly, they can earn the spread in between, yeah? So they buy the debt at 60% of the face value and they sell the debt back to the debtor country at 80%, okay? So in between, they have earned a 20% of spread. Now, so what do these corporations do? The reason why they want to get involved is because they have interest in the local economy at the start, okay? So once they redeem the $80 million of the loan in the local currency, they are going to use that money to reinvest in the local economy, right? In the Mexican economy in this example. So the benefit here for the multi-corporation is that they get to invest in the country of their choice, and at the same time they get to earn a spread in between the creditors and the borrower. Okay. So the three parties involved in the debt to equity swap are all better off. With the creditor, they get to redeem 60% of their debt, right? So instead of writing off 100%, they get to write off just 40%. With the multinational corporation, they get to earn a spread of 20%, and at the same time, they get to invest in the country that they initially wanted to invest anyway, right? With the borrower, with the debtor country, they get to reduce their debt payment, in this case by 20%, and they get to pay in their own currency, right? So they are protected from further depreciation of their currency, okay? So it was a very popular thing to do after the Latin American crisis. Now, for example, in Brazil, the Brazilian sovereign debt was discounted at 21% per dollar. Mexican debt 43%. Argentine debt was 14.25%, right? So the corporations that were interested in investing in these countries were Chrysler, for example, and Volkswagen, okay? So in each of these examples, the corporations got to invest at a discount, okay? Now, a second solution came about by the US Treasury Secretary at that time, Nicholas Brady. So what he did was he proposed three different ways that the credited banks could consider. So firstly, to solve the problem, they could convert their loans into marketable bonds with a face value equal to 65% of the original loan amount. So they are asking the credited banks to forgive about 35% of the loans, okay? Second, they were suggested to convert the loans into collateralized bonds. with the reduced interest rate of 6.5. Okay, so they were asked to reduce the interest payment they charge on the debtor countries. And finally, the final suggestion was to lend additional amount to these countries to help them get through the crisis. Okay, so given the three alternatives, most of the US banks chose option 2, which is to convert the loans into collateralized bonds and reduce the interest rate. Okay. Now, because this was originated by Brady, it was called Brady bonds. Okay. So by doing so, by going with option 2, when you convert a loan into a collateralized bond with a reduced interest rate of 6.5%. So if you remember from our present value calculation of a mortgage loan, right? So every time when you reduce the interest rate, you're going to have to extend the maturity of the loan, okay? So by reducing interest rate to 6.5, essentially the banks agreed to extend the maturity of the debt by about 25 to 30 years, okay? Now, the loans are converted into collateralized bonds. That means these bonds have to be backed up by a financial asset, okay? And the required financial asset was zero coupon US Treasury bonds. So the effect was that these countries, the debtor countries, they've got to buy zero coupon bonds from the US, okay? So as we mentioned before, because this was proposed by Brady, it was later called Brady bonds, okay? So in total, the Brady bonds were used to solve the problem of the Latin American countries. And by 1992, most of the countries have got out of the trouble, okay? So the key lesson here is that there were too much concentration into the Latin American countries. And as you can see, if there is easy money, then it's very likely that there will be a crisis following, okay? So when there is too much liquidity going in the system, people become careless and they will make bad decisions, okay? So moving on to the next financial crisis. Now, we have talked quite a bit about financial crisis, the global financial crisis in 2007. So in this lecture, I'm going to skip through some of the details that we talked about before, and I'll focus on some of the details that we haven't discussed, okay? So as we all know, the crisis started in 2007, and by the end of 2008, the US officially announced that this is a recession, okay? So the crisis started with the credit crunch, and it has turned into a global economic downturn, okay? So the credit crunch refers to the inability of borrowers to obtain credit, and it began in the fall 2007, okay? The contributing factors that caused the credit crunch at the first place were 3 of these factors. So there was a relaxation of banking regulation. There was a big global savings glut. So there was liquidity, a lot of liquidity in the system, okay? And the interest rate environment in the US was quite low before the crisis happened, okay? So the starting point of all the trouble was the liberalization of banking regulation. Now, in 1983, there was an act that prevented commercial banks and other banking business, okay? So the Glass-Steagall Act in 1933 prevented any commercial banks from conducting investment banking services. So commercial bank services are deposit taking and loan making, okay? So only commercial banks were allowed to take deposits and lend to other people. Investment banks are to help with security issuance, brokerage services, so on and so forth, but they were not allowed to lend and take deposits. Okay, it was repealed in 1933, and following that leave of restriction, there has been a blurring of the functions of commercial banks and investment banks. Okay, so after the regulation was removed, everyone can do whatever they want. Okay. Now the danger of that is that with commercial banking, there is a heavily regulated sector. So if you want to have a commercial banking license, you need to make sure you follow strict rules, okay? And you need to make sure that you are monitored by the regulators. But for investment banks, insurance companies, so on and so forth, they are not subject to the same regulation, okay? So as the Glass-Steagall Acts were removed, everyone could do anything. Even insurance companies can come up with an idea where they can get deposits, okay? So as a result of the liberalization of the banking industry in the US, it has given way to a shadow banking system, okay? Whereby even investment banks can take deposits and lend money to people, okay? So one recent example that we can think of now is if you think about lending platforms, right? So if you think about crowdfunding, it is a sort of shadow banking. Okay, so when you go into a lending platform and lend to people, that is when you're doing the banking business, yeah, without having a license. Okay, so this is what we refer to as the shadow banking sector, where we do banking business, but we are not subject to the same regulation as a commercial bank. All right. So the second contributing factor was that a lot of developing countries became developed, like China, Japan, so on and so forth. So over time, these economies have become stronger, and as they became stronger, they started to save more. Okay, so it's similar to before, when people started to save more, they want to invest more. Okay, so as they deposit more money into the banking sector, the banks find it desperate to find alternative investment opportunities. Okay. So the end result was that there was a lot of funding flowing into the US, making US interest rate very low. Okay. At the same time, the US government at that time also encouraged a low interest rate environment. The end result is, of course, with low interest rate, it encouraged people to borrow more. And the danger is here, okay? So as people borrow more, they did not borrow money for further investment, but a lot of them borrow money for further consumption, okay? So if you think about consumption as an investment, this is a negative NPV investment, okay? So as you consume more, your money gets lower, it doesn't grow, okay? So the combined effect of a low interest rate environment and a lack of regulation was that there was a lot of risk building up in the system, okay? So on top of that, there were a development in the subprime mortgage market and mortgage-backed securities, okay? So we have talked about this before, so I'm gonna skip through this slide. But basically, there were a lot of subprime mortgage lending, and there were a lot of subprime mortgage-backed securities as well, okay? So who invested in subprime mortgage-backed securities, okay? Now, with mortgage-backed securities, because they are derivatives, if the banks hold them on the book, they are required to hold additional capital reserves, right, to buffer against that risk. So what they did was they created a structure called structured investment vehicles. So these are basically like trusts, and these trusts buy off the mortgage-backed securities from the banks, essentially taking it off the balance sheet of the bank, okay, so that the banks are not required to hold more capital on their mortgage securities. Okay, so the way these structured investment vehicles were funded was that they raised short-term funding, and they used that money to buy mortgage-backed securities. Okay, so they borrow short-term and they buy these mortgage-backed securities. Okay, now as a result, when there was a credit freeze in the commercial paper market, which is a short-term funding market, these these entities were very, very much affected, right? So they could not raise short-term funds anymore. Okay. So another big bias of mortgage-backed securities are collateralized debt obligations. So they are basically a corporate entity that specializes in buying financial assets, right? Fixed income assets into tranches. Now, for these big players in the mortgage-backed securities, the way they hedge their risk is that they use credit default swaps, right? So credit default swap is like an insurance contract between a buyer and a seller, and they are written on the default risk of a company, okay? The default event is referred to as a credit event, and the buyer will pay the seller an annual payment, which is a insurance premium, okay? So when the company defaults, the buyer is going to redeem their bonds from the seller, right, from the insurance company. So for example, if I have a 5-year credit default swap contract on a notional amount of $100 million with a spread of 80 basis points, that means I will pay the insurance seller, I'll pay the credit default swap seller $800,000 per year as insurance premium, okay? And if within that 5-year period, if the company in question defaults, I'm going to redeem $100 million from the credit default swap by seller, okay? So this is how it provides me with an insurance against the default of the company, okay? So the problem started when the mortgage-backed security market became to have some problem, okay? So as the economy started to have some troubles, funding were becoming very hard to find. A lot of the investors in mortgage-backed securities found it hard to finance themselves, okay? So as these companies found it very hard to finance themselves, they also found it very hard to sell off their risky mortgage-backed security tranches, okay? Because there were no one wanting to buy them. So as they wrote off a large chunk of their MBS, their credit rating started to go down because they got downgraded by the credit rating agencies. Okay. Now, at the same time, adding to their trouble, the credit default swap sellers started to default as well, right? So as we mentioned before, with the credit default swap sellers, they are basically insurance companies. And as the mortgage-backed securities started to default, their liabilities started to increase up until a point when they cannot pay their liabilities anymore, okay? So from the default of the credit default swap insurers, the banks that bought their credit default swaps started to have troubles as well, okay? Because they can no longer claim on this insurance. And that reduces the quality of their capital. So the effect of all of these troubles were that, firstly, for the financial industry, now on the graph that I show you on the left, this is what happens to the investment yields, right, of 3-month Eurodollar bonds and 3-month T-bill rates. Okay, so during the crisis, this was during the crisis period. What happened was all of these investment rates drop, and also by the peak of the crisis, we have seen an increase in credit spread. Okay, so the TED spread tells you the credit risk premium in the economy. Okay, if this shoots up, that means it's more expensive to hedge against credit risk. Okay, or the credit risk premium becomes larger. So a few casualties in the financial industry include Northern Rock, the British Bank, Bear Stearns. This is an insurance company. It was later acquired by JP Morgan, Bank of America, and Merrill Lynch. And the most famous casualty was the Lehman Brothers. Okay, it was a very old bank that failed because they had too much exposure in the mortgage debt market. So the effect of the financial crisis did not stop there. It also affected the value of the houses in the US. Okay, so at the peak of the crisis, this graph shows you the Schindler Index, house price index. So if the index increases, that means the average price in America has increased, and vice versa. Okay, so during the crisis from 2007 to 2009, there was a big drop in the house prices in America, right? So if you think about home equity, if you have ever bought a house, then you will understand that a drop in house price is very severe for investors, because that means your equity drops. Okay, meaning that in the future, if you want to borrow for further property investment, it's going to be harder for you. Okay. At the same time, because of the economic crisis, the US experienced a large jump in their unemployment rate. Okay, so before the crisis, it was somewhere here at around 4-something%. At the peak of the crisis, it was 10%, right? So over the 3-year period, there was an increase of 7% in the unemployment rate. Okay. Hopefully we don't see the same thing this time around with the COVID-19, but it is really bad. Right, so in response to these troubles, the central banks around the world has introduced a lot of stimulus packages. So in the US, for example, they have reduced the cash rates, the Fed fund rate, by a lot. So from about 5.25% to just 0.25%, right, in 2008, to reduce the funding cost of the banks. They have also bought a lot of securities from the troubled banks. This is called quantitative easing. Okay. And they have also established a lot of other facilities to help provide liquidity to US companies. Okay. Other banks follow the same strategy. So during the crisis period, a lot of banks also decreased their interest rates, especially in Japan, right? Even in Japan, where they have a low interest rate. Okay, and a lot of other countries have different quantitative easing methods as well. So the lessons from the financial crisis were, firstly, there was a moral hazard problem in the system, in the sense that the credit rating agencies were asked to rate the companies that pay them. Okay, so the companies that write the mortgage-backed securities were the ones that pay the credit rating agencies to rate their own securities. Okay, so because of this problem, they did not have an incentive to downgrade the mortgage-backed securities, right? Until the problem became too serious. Second, because of the securitization process where the banks write off their mortgage loans into mortgage-backed securities, they no longer have the incentive to monitor the loans, right, or screen the borrowers. And as a result, this creates a moral hazard problem as well. Also, there was a lack of understanding of the kind of risks that the banks were taking. So a lot of banks hedged their mortgage-backed securities portfolio using credit default swap, right? Without realizing that their credit default swap is not risk-free, okay? So in the end, after everything was unfolded, we found out that everything was written on the same fundamentals. And as a result, when one thing fell, other things started to follow as well, okay? Okay. So to summarize this lecture, in this topic, we have talked about, we have introduced different types of international banking services, different types of money market instruments in the international markets. We have also talked about using the forward rate agreement to hedge interest rate risk, okay? In the second part of the lecture, we talked about two notable debt crises in the past, and we discussed the lessons as well as the solutions for these crises, okay? So that was the end of the topic today. Now we have about 20 minutes. So if you wanted to ask me anything about the topic or about the final exam, this is a good time to do so, okay? Is there any questions at all regarding this? Yes, Zachary?
Yeah, I just have a quick question about the final exam.
Yes.
So I read over what you posted on the Word document, how it's split into 3 parts.
Yeah.
And you have to complete it in sequence.
Mm-hmm.
Do you have to do, say you do part 1, do you have to do part 2 straight away, or would you be able to take like a 5-minute break in between parts?
You can. So the exam will be open for a total of 6 hours.
Yeah.
So you can choose any time to start and take a break.
And so is it going to be similar to the midterm where it's just posted on the LMS, or?
Yes, exactly.
Okay,
yeah.
Thank you.
Good question. So the total time window for the exam is going to be 6 hours from 10 to 8, I guess. Is it right? I think it's from 12 to 8 on the exam date. And you can take as many breaks as you like within that time, okay? Just make sure you allow enough time to complete each of the parts. Any more questions? All right, so if there is no more questions, I'm going to conclude the class for now. And as usual, if you have any questions, feel free to post on the student forum or email me, okay? Other than that, I will see you next week, okay? Have a good week ahead, and I will see you either Tuesday or Wednesday next week.